So before I get to a Q&A with our panelists, I'm going to share for the benefit of our panelists some of the findings from our recently conducted advisor confidence survey, which covered a lot of business, product and market perspectives. This constitutes largely the voice of most of the people in this room. We had about 230 participants who participated in that survey, all leading IFAs from about 40 odd cities, many of whom are present here. So you'll get a good sense in terms of what they think on markets and what they think in terms of product preferences, which perhaps can set the tone for our discussions. So if you can see here the market confidence that's there on your comfort screens, we asked a question, where do you expect the Sensex to be at the end of this fiscal? And the mood in this room, if it hasn't changed from the early June when most of them responded, is fairly optimistic. There are only 7% of respondents who think that markets will perhaps go to one trading band lower than where it is. And as many as 67%, that's 47 plus 20, who believe it will go at least one band higher, if not two bands higher. And an arithmetic average of a Sensex forecast comes to some 33,000 odd for March 2018. So the mood on equities is clearly fairly optimistic. In terms of expectations on interest rates, range bound seems to be the answer from most of the advisors. Although these ranges from a fixed income point of view, you might argue are very, very large, but 6 to 7% is where most of our advisors have pegged interest rates, and therefore we come to an arithmetical mean of something like 6.47, which is miraculously close to where we are. So that's the mood in terms of, that's the view in terms of markets. Moving on to product confidence in equity space, the message that I see is a shift from go anywhere to go everywhere. And why do I say that? Is if you look at the earlier years, you look at 2013-14, diversified no cap bias, which was the go anywhere strategies, were clearly the most preferred product for our advisors, as in they had the highest confidence in recommending those products. Mid caps peaked in 2014 at 63%, as in 63% of respondents were very happy recommending mid-cap funds to their investors. That 63% has come down all the way to 20% in this year's survey, and you can see the way it has declined pretty much in inverse proportion to the incline in the mid-cap indices. So there's not too much of confidence in recommending mid-cap funds today. There is, however, a lot more confidence in recommending multi-cap funds. So which is why, you know, the surmise I had is that a multi-cap is a go everywhere. So they're not even expecting you to go into large or mid. They're saying just be there in the market. So that seems to be one of the messages coming from our leading IFAs. In terms of debt, the product confidence, some fairly sharp moves. If you look at the annual trends from 2014 to 17, this is with a 3-year horizon. So people, you know, the question was which debt-oriented funds would you be confident recommending with a 3-year perspective? Income funds and gilt funds are now slipped to single digits. Very, very few advisors are happy recommending them from a 3-year perspective. Dynamic bond funds has seen quite a sharp dip from last year to this year. Credit opportunities funds, basically the accrual space, continues to grow from strength to strength in terms of advisor confidence. So the broad message seems to be no to duration and yes to accrual, right? So now with that as a background in terms of what we believe, what we feel that we're confident recommending, if I can then look at some of the questions on the equity side first, and then we go on to debt. Now, confidence in the markets seems to be fairly high, and this is a question for Prashant and for Mahesh. And obviously, the other CIOs are free to add their comments, but since I cannot ask all questions to everybody, I'm just sort of randomly picking. So, while the confidence on markets seems to be fairly sanguine. One clear message that is coming across for Prashant and Mahesh is that the confidence on mid-cap space is waning quite significantly. Are we in a mid-cap bubble? We hear a lot of fund managers saying, look, I find a lot of bottom-up stock picking opportunities, so don't worry. Right? There are the naysayers who say that, look, that is exactly what a buy-side manager is supposed to say. He's never going to come and tell you, look, please don't buy mid-cap, it is overvalued. But we need to exercise our own discretion and say, look, if valuations are stretched, we should not recommend mid-cap funds at this point of time. How does one get a balanced perspective on the mid-cap space? Prashant, if I can ask you first and then Mahesh. So there's a mic there.
So I think bubble is a very strong word in my opinion.
Yes, it is. Just to start a debate.
Bubble is not a right word. I think it is fair to say that mid-caps are more expensive than averages and they are also more expensive than large caps. But bubble is where you can lose 80-90%, 70% value. I don't think, in our opinion, that is the case, number one. Number two, mid-caps is a very large number of companies.
Yes.
Unlike large caps, which are maybe 100, 150, mid-caps are in few hundreds. So there will always be pockets of value. And therefore, someone who has a better skill set, better team, better insights, whatever, you can always do a better than average job. So if someone says, look, I am able to find value and create a portfolio of 30 stocks which offers reasonable value, I think that is possible, even if mid-cap indices or mid-cap averages are suggesting that things are stretched. Third, I think, in my opinion, it is a myth or it is wrong to say that mid-caps grow faster in terms of earnings than large caps. I don't think that is true, while many people have been saying that. And if you look at most of the indices, most of the sectors, in every sector you will find, at least in 7, 8 out of 10 cases, the larger companies in the same sector are growing faster than their smaller companies in the same sectors.
Correct.
So look at the fastest growing airlines or four-wheeler companies or even mutual funds or insurance companies. The bigger companies have competitive advantages, and which, if utilized properly, leads to a situation where in most cases, not in all cases, there can be some exceptions, large companies should grow faster. I think it is wrong to say that large cap funds or multi-cap funds will always create 5-7% lower returns than mid-cap funds. I don't think that is the case.
So you believe that there is still this bottom-up stock picking opportunities in mid-cap, notwithstanding the top line number which seems to suggest that valuations are stretched?
See, it will always be there.
Yeah.
Even when market P's were 40 times, way back in 92.
Yeah.
Even then there were some pockets which were undervalued. But then the dependence on stock picking or the individual manager tends to keep on increasing. But when we are talking here, I presume we are talking of mid caps as a group of funds. So in that space, I think it would be wrong to carry an expectation that over next 3-5 years, the mid-cap funds will deliver meaningfully higher returns than large-cap funds. It could be even lower slightly. I don't think there is any cause to worry, but it is definitely, there is a need to get our expectations right when it comes to mid-cap funds, particularly at this point of time when things are not cheap.
Sure. Mahesh, if I can ask you to come in on that, and the other dimension that a lot of advisors, this the fall from 60% confidence levels to 20% confidence levels is quite stark in the last 4 years. Some of the concerns that are being expressed is that there is a gush of liquidity coming into mid-cap stocks, either because of mid-cap funds getting a lot more money, chasing past returns, and because of a lot of money coming into the PMS schemes, which again target mid-cap and small-cap, because a lot of the PMS mandates that HNI clients seem to prefer, again, is in mid-cap, for exactly the reason that Prashant said, that there is a belief that mid-caps will outperform over a market cycle, so why don't I get more juice, etc. So how does one therefore dissect this whole mid-cap space? Would you agree with the advisor view that, look, let's go a little cautious on mid-cap funds now?
Yeah, so I would agree with Prashant when he says that the mid-cap they're not in the bubble zone, but clearly if you look at the returns in the mid-cap space over the last 3.5 years has been stupendous. The mid-caps came from a lower bottom also. I mean, they were very depressed, say, 4 years back. If you look at the government came to power around 2.5, 3 years back, they were very depressed. And from there, we have seen a P-rating as well as some kind of a earnings growth. I wouldn't say is really been higher than the larger cap space. But I think going forward from here, I think one myth is that the mid-cap P multiples on a trailing basis, they look at, if you look at it, it's more than 30 times. Right, Nifty will be somewhere around 22 times or so on a trailing basis, because future earnings, you don't know what actually the earnings will be. But if you remove some of these loss-making companies which are there, okay, then the difference gap is not as huge as it looks like.
Sure.
And normally what happens is that when you come from a economy which is been down now, okay, in the upturn, the mid-cap earnings growth, at least in the initial period, is much higher because the earnings also get more severely hit in a downturn.
Sure.
And that's what market is expecting, that the mid-cap earnings growth will be better in the next few years than the larger cap. And that's the reason why the higher valuations which is there currently will get normalized. Only time will tell whether that happens or not. But I would say that, yeah, at this point in time, looking at the relative valuations and looking at where the market is, it's prudent to be slightly cautious on the mid-cap space, at least from a near-term perspective. Because when the valuations are on the higher side and the downside support is much less, and if there at all there is a correction in the market, you will see a larger volatility in the mid-cap space.
Sure.
So the near-term risk-reward, I would say, because in mid-caps, when you're buying a mid-cap fund or this thing, you would expect a higher return because the risk and the volatility would be larger than, say, in the larger cap fund. Whether it will compensate for that, at this point in time, the risk-reward looks slightly unfavorable from a shorter-term perspective. Obviously, from a longer-term perspective, I think mid-cap India, because of the emerging nature and because a lot of there are emerging sectors which are coming up, companies which are coming up, either through some of them, a lot of companies are in the unlisted space which come in, you can participate that in the fund, the ability to generate alpha in the mid-cap space is obviously much better than in the larger cap space.
Sure.
So even arguably, I think over a longer term, I think a mid-cap fund, if you look at the fund manager, should be able to generate a better alpha than the index, than the large cap, because the large cap, the bandwidth or this thing is much limited over there.
Sure.
So I think those opportunities will there in the mid-cap fund. So I think despite the slightly higher valuation, I think one needs to make some allocation to the mid-cap space, even for somebody who's looking to invest, say, from a 3-year perspective. Obviously, it can't be a large, I mean, 2 years back, we saw almost like 40-50% of the inflows were going in the mid-cap space, which again creates a problem because mid-cap can't absorb that kind of a capacity and liquidity, right? There is a finite space to it.
Sure.
So I think if you do the right allocation to the mid-cap space, even from your, say, a longer-term perspective, I think there can still be decent returns to be made in that. But I think clearly it has to be much lower than what the allocation has been in the past.
Got it, got it.